Welcome back. Good going for the market. The SGX Nifty this morning was indicating something else, but the market had its different mind. And it's been a very strong market. Even though there are shorts in the system, the market just refuses to fall. Some stocks which stand out right now, Vodafone Idea all of a sudden is making a move, 5% higher on that stock. So big move coming in on that stock. And Tata Communications is the other one, which is seeing a bit of a breakaway gap, so 2% higher on that. And metals as a pack have done well today. But what's done well over the last 6 months clearly is the hotels pack. You've seen hotel stocks buzzing with festive season upon us. Lemon Tree is just 10% away from its 52-week high. The company has been adding a slew of properties across the country in line with the target to get to 20,000 rooms in the next 4 years, and has also seen room rates surge over 20% from the pre-COVID levels. To discuss the demand trends, we are now joined by Patanjali Keswani, Chairman and Managing Director at Lemon Tree Hotels. Mr. Keswani, good morning. Last time we spoke to you, you were quite bullish. But do you think that things have crossed even the best case scenario that you may have envisaged, say 2 or 3 months back? Clearly there's some kind of boom in the travel industry.
I don't think, firstly, good morning. I don't think we are anywhere near what I think would be boom times. That would, in my opinion, wait for another 3 to 4 months, because while foreign travel has started, meetings, incentives, there are different segments that are not at full volume yet and full demand yet. And that will take, in my opinion, as I said, 2 or 3 months. So really it will be Q3 and Q4, which will be, well, using your word, boom times. And that the bigger issue is actually it will continue for the next 2 or 3 years, because there is really no fresh supply coming, and demand is really increasing quarter by quarter.
Okay, what are the rates like right now? How are they trending at? Are they much higher than what they were earlier? If you can give us some numbers, what are the occupancy levels?
So occupancy levels in summer, typically every year, are about 10% lower than what they are in winter, Sonia. So they are like what would be the case every year. So actually occupancy levels are not higher than pre-COVID. They are somewhat similar. Rates are much higher. And what I want to just tell you is that the rates, I expect that there will be a 20% increase in rates in Q3 and Q4 from the current rates in the branded hotel sector. And demand will also be at least 10% higher. So if you look at it from a revenue perspective, revenue, in my opinion, should be 30 to 40% higher per room in H2 compared to H1. And I'm talking about the industry, by the way. I'm not talking about Lemon Tree.
How long do you think it would take for the occupancy levels to get back to the pre-COVID levels?
H2.
In the second half, okay.
No, it would exceed, not get to. It is already at pre-COVID levels in H1.
Okay.
Mr. Keswani, you're maintaining your sort of sense of bullishness that this momentum will last for the next couple of years. But with historical context, I remember you explaining to us, or maybe the time you were on before our last interaction, that rates in some marquee properties are just about getting back to where they were 20 years ago. Even after 20-year gaps, rates are still there. All that is fine, but will there be any some amount of demand destruction as well with these kind of room tariffs? It's true that there is no great supply which is coming into the market, so room inventory is not going to change materially. But even with what we have, will there be any hit on demand?
Not really, because I'll tell you why. Memory is short. In the 2 years of COVID, the regular customer of hotel rooms actually stopped visiting hotels. It was only exceptional reasons people stayed in hotels, which is why there was hardly any demand. So the customers who have come back, whether it is B2B, large corporates, or whether it is B2C, which is individuals, I think everybody has forgotten what the rates were 3 years ago. So just to answer your point, I think value is, perceived to be a function of what the market offers. And the market across the board has increased prices. So I don't agree with that. I don't think there has been any significant level of demand destruction. Quite the contrary, I see there has been demand creation. But we are still, as I said, at pre-COVID levels of demand. And my expectation is that in H2, finally, our industry will will continue on that trend line, which was still till COVID hit us, which was an increasing demand situation. And that is why I say there will be boom times for the next 3 years.
You're saying that it's going to exceed pre-COVID levels in H2. Are you factoring a bigger growth by the end of the year? I mean, you're sitting at about 400 crores of revenues in FY22. Even if you go by, say, 30-35% growth, we're looking at about...
I said we will be more than double in revenues. You're comparing the wrong base. Our revenue before we had added a bunch of hotels way back in 2020 was close to 700 crores, 670 crores.
Yes.
Do not compare the previous year. All I said is that we will do over 800 crores, well over 800 crores this year. Okay. And to give you just some flavor, and this is not, again, I don't want to talk specifically about Lemon Tree. What I'm saying is that on a secular basis, in the last 10 years, Sonia, demand has grown at north of 10% a year for branded hotel rooms. And I'm talking in absolute numbers, okay? What happened was supply was also growing a lot, which is why the occupancy did not really go up. So what I'm seeing now is that there is no supply growth or no significant supply growth, but demand growth has gone back to its 10-12% a year. So what does that mean? It means in the next 2 years, occupancy or demand will be 20% higher than, say, now. But there will be no supply growth. So what does that mean for hotels? It means operating leverage. It means you increase prices and it goes straight to your bottom line. So here's a guess. In 2 years, all hotel companies will have doubled their normal EBITDA.
Okay.
All organized branded players.
And this 800 crores, actually, if you look at it in the last, about 5 or 7 years, you haven't done that kind of, even pre-COVID, right? I mean, pre-COVID also, your best in FY20 was 700 crores, as you said. Before that, on an average, I mean, I know you've added more hotels now, etc., so that number goes up. But what would the plans be in future of adding more rooms, any kind of fresh investments that you're looking at?
Well, we are just making one single investment, which is a chunky one of about 1,000 crores, which is our big hotel in Bombay. We've invested about 400-500 crores already. Other than that, we are not looking at now investing more capital in the asset creation side. So we are investing capital now on a digital transformation, which we're undertaking, on a renovation of all our hotels. And my expectation is that we will generate enough cash that in the next 4 years, we will be debt-free and we will no longer require capital. So in fact, we are now taking capital out in the sense that we are taking, whatever we earn, we are putting to remove the debt on our books. And after that, we will simply be a dividend-paying company because I do not anticipate that we require any cash injections in the company.
The next few years, you're targeting to become debt-free. You're currently at what, about 1,700 crores of debt. Right. By the end of FY23, where will you be? And what is it by the end of FY24?
You're asking for guidance in a very clever way, Sonia. Let me put it this way. I said our EBITDA will be at least 50%. Our revenue will be at least 100% higher. So if you do the math, what I'm saying is that I need 500-600 crores to finish our Bombay hotel, maybe a couple of 100 crores to do the digital transformation and renovation, and 1,700 crores of debt. So what I have indirectly said is that put together, I need 2,500 crores of cash to write off, to pay my debt and to do all this. And I have said that within the next 4 to 5 years, at most, we will be debt free. So I'm basically saying we will make 2,500 crores of cash in the next 5 years. Okay.
Well, it's my job to ask you for guidance cleverly, right? And thank you. Thanks for stopping by and speaking to CNBC-TV18. And taking all our questions quite well. We got a lot of data from there. Thanks a lot for being with us. So that's Lemon Tree Hotels. But let's move on from the hotel to the electric vehicle space. Very interesting developments. The electric vehicle viability is now being questioned globally in the wake of the global power crisis. So, for example, in the state of California, electric vehicle owners have been asked to refrain from charging their cars to avert power outages. And this is the exact same state that was encouraging people to buy electric vehicles a year ago. Chetan Maini, who is the co-founder and vice chairman at Sun Mobility, and Vaibhav Pratap Singh, the program lead at the Council on Energy, Environment and Water, joins us now to talk about that. Chetan, good morning. Vaibhav, morning to you as well. Chetan, I want to begin with you. You know, what's happening in California speaks about the challenges on infrastructure, on power, that even developed countries are facing. What do you think the implications of this would be for the EV market in India?
So I think it's a little overblown. I think we put in context. India is looking at doing 8.5 million air conditioners this year. To put that in perspective, that would be equivalent to putting around 70 million scooters on our roads in a year, and we produce around 20 million all scooters, electric and gas. This year we may produce 1 million. So with a grid that's anyway has to cater to other things, the electric vehicle side, especially, which is driven a lot by 2- and 3-wheelers, is going to be a very, very insignificant amount on impact on the grid. Some of the global markets like California that have very high air conditioning requirements, all houses are air conditioned and 1% of households have cars, they need to balance the power. So I don't think it's talking about shutting it down. It's just saying, hey, listen, between 4 and 9, there's peak power demand on air conditioning. And instead of charging your vehicle between 4 and 9, charge it at night when there's surplus power. So we'll have to get smarter on the grid side, but I don't see this having any impact, in the short to medium term in India. And by 2030, as India is adding the kind of renewable energy of 500 and plus gigawatts of energy, if every vehicle in India by 2030 was electric, highly unlikely, there's over 300 million of them, we would need probably less than half of that renewable energy to power the entire country. So it's just a matter of perspective of where we think about it. And while there are, certain challenges at the last point of transformers and everything, which has to come through, don't get me wrong there. But overall, I don't think we would have a challenge because we have the time to build up the infrastructure while the electric vehicle industry also grows in the country.
Okay, that's for that particularly you're talking about the Indian market, right?
That's correct, yes.
Okay, got that. Let me get Vaibhav Pratap Singh as well into the discussion. Vaibhav, do you agree with Chetan that, EVs in general have a very low impact on the power grid? So even if the power crisis escalates globally, it may not really impact the viability of the business per se. Your views?
Yeah, I concur with Chetan on that. And thanks, Sonia, for asking me over here. If we take the specific example of California, what the Californian grid today is observing is an intense heat wave and the impact around ACs, because the demand has just shot up. And usually the demand used to look like somewhere around 26,000 megawatt at the peak. And today it stands at around 46,000 megawatts. And that entire capacity is around somewhere around 47, 48 thousand megawatts that they could produce at any point in time. So this is majorly an electricity crisis that the state is facing, similar in line that many other states globally have faced. And as Chetan pointed out, that the electricity EVs, even though the California leads in the numbers where there are more than 1 million EVs out there, if you just assume that only 10% of these EVs are being charged at any point in time, the impact on the grid would be very, very, very minuscule. So it's not the EVs that are leading to such catastrophic high increase in the demand. It's more of a climate change that's impacting the grid because you are moving into electrification of the grid at any point in time, and the cooling demands are just keep pumping up. So if you just look at the what were the guidance note, it also asked the AC users to keep their AC temperature slightly higher, and this really works. So I guess it's a combination of everything. And even if I can take the example of India, in India, the EV demand, if we assume even the EV30 targets and every other targets, the peak demand could only be impacted by 300, 400 basis points as per different studies out there. So it's not a very huge jump in the terms of electricity demand.
Okay, I'm glad you brought about that EV 2030 target, right? Because Chetan, I wanted to get you in on this. Union Minister Nitin Gadkari had said that by 2030, the government intends to have EV sales accounting for 30% of private cars. But where are we right now? I mean, less than 4% of private cars are constituted by EVs. Now, there are two reasons why this mass adoption is being hindered, right? One, of course, is the charging infrastructure, which is not very easily accessible, and there are challenges there. And the other one is the high cost of EVs. On these 2 points, do you think that there are viable solutions? And do you think this target will be met by 2030? It looks ambitious as of now.
So, let's look at the different segments, right? In three-wheelers, we've already crossed 51% in the last couple of months of all electric, 31% of all three-wheelers sold in India are electric, right? In the two-wheelers, we're close to 4.5 to 5%, which is an 8x growth from last year, right? Buses, India is trying to target 50,000 electric buses, which again would constitute a large part. Cars have been, but they're also a smaller portion of the entire electric mobility side of it. The 2 points you talked about was cost and infrastructure, and I do think these are very important areas. And what we felt that at least in the two-wheeler and three-wheeler and the buses and truck area, when you separate the vehicles, the batteries from the vehicles, you can get the cost of electric vehicles to be cost neutral or cheaper. And by swapping the batteries, you can get the cost of energy to be at least 20% cheaper. So we do believe technologies like battery swapping would address those issues of high cost, range anxiety, long refilling time, and infrastructure. And they're going to be one of the many solutions. Along with infrastructure, a regular charging infrastructure that's coming out across the country. It's a chicken and egg thing, but it seems to me there is movement there. And at this point, we do see them going together. And I do believe that 30% of by 2030 in several segments will be exceeded, and maybe in the cars, maybe borderline of achieving it.
Okay, Weber, very quickly, battery swapping can address the issues of the high cost issues that are present in commercial EVs. What about passenger cars?
So I would say passenger cars, if we go by why EVs are making an inroads out there in the market, it's because they make commercial sense out there. So on an upfront basis, most of the EVs, if I talk about four-wheelers, they are almost 70-80% more expensive than the usual cars out there. And so it's a very niche story that borders around which sector segment or we are referring to. So if we refer to the passenger vehicles or four-wheelers out there, last year it was a sale of 18,000 vehicles around, roughly. And this year we can expect, even if we jump, so 1 lakh EVs out there. So it has to make commercial sense because EVs by nature are operational efficient. So they allow you to lower your operating costs. So instead of burning the petrol or diesel or whatever you are running your normal vehicle upon, you could just switch to an EV and your operating cost just shoots down. So it's these niches where the EVs really make sense, where you could just, let's say, it could be your home delivery of food. It could be a Swiggy guy who could be just hopping on a bike out there and just using it for delivering. And similarly, you could see some startups that are coming up out there for end consumer, I would say, taking consumers just like Uber and Ola's are doing. So
Sure.
this is where the EVs make sense, and the personal mobility will take time to evolve.
Okay, that seems to be the summary of it, right? EV personal mobility will definitely take time to evolve, especially with the ongoing power crisis globally. Perhaps that could affect a bit of demand across the board. But let's do one thing. Let's thank Vaibhav and Chetan for joining in. Slip into a quick break. Markets are doing very well, so we'll come back with Mitesh Thakkar for some technical trades. Do stay tuned in.
Welcome back. Well, what a strong morning for the market. The first hour has been absolutely strong. The Nifty is up 104 points now. The Bank Nifty is up 305 points. The mid-cap index doing well. Advanced decline at 3:1. The top gainer now, by the way, is Federal Bank, 6% higher on that stock. Mahindra and Mahindra Financials is up about 3.5%. PVR is up 2.5%. Tata Communications is up. Exide. So many individual stocks doing well right now. Mitesh is back with us. Mitesh, been a very strong first hour. The market actually never really gave a dip. I mean, if the thesis was to buy the dip, you had to buy the consolidation or that minor uptick. But your thoughts now and your stock calls.
Yeah. So that's right. I think, there was no proper dip. In fact, despite the fact that the SGX was slightly negative. So I think that only suggests that the lower end of the range, there's strong demand. And I think eventually that confirms that the eventual breakout will be on the upside. Though I suspect we're still some time away from that. For the time being, I think the stock call that I have, Exide, the battery maker is breaking out nicely on the charts. So that's a good setup. So buy to stop just below 159.5 for targets of around 171, 172 on the upside. And the other stock is Intellect Design. That's a buy as well. Good price action over here today. First hourly candle is very bullish. That's a buy with the stop at 604 for targets of 640.
Okay, thanks a lot for that. That's on Intellect Design Arena, up about 3% But M&M Financial is gaining ground on the back of its numbers that came through on disbursals. Abhishek is here to give us the latest. Abhishek, over to you.
Well, Sonia, the monthly business update has come in for M&M Finance, wherein they say that the disbursals were at around 3,740 crores, up about 75% YOY, but it's down about 4.5% on a month-on-month basis. So YTD or year-to-date disbursals are around 17,150 crore, which is up 104% YOY. Collection efficiency remained healthy. It has come in at 96% for the month of August. This compares to about 97% for the month of July. Overall, the stage 2 loans, which are overdues more than 60 days but less than 90 days, that has improved on a month-on-month basis. But stage 3 or the gross NPA ratios have remained stable. So company expects improvement in both stage 2 and stage 3 in the month of September. Back to you.
Abhishek, thanks very much for that. Antique has got a note out on diagnostic companies. They are all under pressure. Nimesh is standing by with more. Nimesh, hi.
Hi, Prashant. So, as you rightly pointed out, both the stocks are under pressure today after a report from Antique, where they've initiated a sell call on both Dr. Lal Pathlabs as well as Metropolis. On Dr. Lal, they have a target price of 1643, a potential more than 30% downside from Friday's levels. And on Metropolis, they have a target price of 1232. Even there, a downside of more than 10% from current levels. So the key reason why they've initiated a sell report is, one, they believe that the COVID-led tailwinds are now behind, and with competition increasing, the industry is staring for a much lower CAGR. In fact, Antique believes that the numbers reported in FY21 in terms of margins will not be reported anytime soon, and they are likely to fall to long-term averages of growth between 10 to 12% versus the 15% plus CAGR which this company has reported in the last few years. Even on return on capital employed, Antique believes that they will come down, they'll fall back again to 25-26% versus the 33% plus that they've reported in the last few years. So there is going to be a valuation derating for the entire sector, and hence Antique has initiated a sell call on both Dr. Lal Pathlabs as well as in Metropolis.
Okay, thanks a lot, Nimesh, for that. So those are a couple of these diagnostic companies. The market is still doing fine, and the Nifty has now hit a century. More than that, actually, 110 points in the green. The Sensex is up over 400 points. But let's take a moment to talk about the tragic news that happened on Sunday, where industrialist and former chairman of Tata Sons, Cyrus Mistry, died in a road accident about 150 kilometers from Mumbai when the car he was travelling in hit a road divider. He was just 54 years old. Mistry was appointed as the chairman of Tata Sons way back in 2012. He went on to serve till 2016. However, he was ousted in 2016 itself. After his Tata stint, Cyrus went on to set up a venture capital firm, Mistry Ventures LLP. Tributes have poured in for Mistry from politicians and industrialists alike. Prime Minister Narendra Modi, in a tweet, expressed shock on the untimely demise and said that Mistry was a promising business leader who believed in India's economic prowess. Tata Sons chairman N. Chandrasekaran also condoled Mistry's sudden and untimely demise. He said, Mistry had a passion for life, and it is really tragic that he passed away at such a young age.
investing.
112 points on the Nifty, so things are looking solid. 17,653 is where we are trading at. Remember, I mean, this is remarkable because of the sharp turn down that we saw in the US on Friday. And of course, the fact that later there's no US market session, markets there are shut for Labor Day holiday. So, I mean, here is just game on. So things are pretty steady. Market breadth also, advanced decline, doing just fine. Now, Bharat Electronics is the company in focus, BEL. It signed an MOU with Smiths Detection India to manufacture high-energy scanning systems. This deal is for a period of 5 years and can be extended further by mutual consent. We have with us Mr. Dinesh Kumar Batra, CMD at BEL. Mr. Batra, thanks very much for joining us here on CNBC TV18. Could you start by telling us what synergies does this deal bring for you in terms of revenues? What's the potential that you're looking at? And when does ordering really start as a result of this tie-up?
See, we are already in the manufacturing of X-ray baggage inspection systems in various form and factor at our Pune unit. Now, to increase our portfolio, we are entering into this MOU with the Smith Detection. What will be the revenue? At the moment, I can't tell you. But as we already in the design and manufacturing of XBIS, joining with Smith Detection will definitely give us more visibility by having the larger portfolio of the scanning equipments.
So what's your assessment of today's scenario on availability of semiconductors and how that would impact production?
Yes. One is there is no denial that there is a shortage of semiconductor. On one account, there is a pent-up demand, and also the full-fledged manufacturing in those countries, those who are making the semiconductors, is not completely operational, etc. And there are further geopolitical things which keep on happening. Now, so far, BL is concerned. For this year, our the revenues what we have planned. So almost most of the orders have been placed. The suppliers have already acknowledged those. Only issue what may face that this gets slightly shifted, like something which was to come in, say, second quarter may get shifted to third quarter or may to fourth quarter, because there may be certain delays. But so far, the targets what we have planned for this year, we do not have any repercussion of those semiconductors or the subsystems like routers, etc., as they also require the chips, etc., in manufacturing of those. So there is no impact on our the revenue growth what we have planned for this year. Of course, there may be certain shifting.
Mr. Batra, you have scaled up your operations from solar cell module manufacturing for execution of solar power plant projects. Could you tell us what are you expecting? What are your hopes from this segment? Also, you've partnered with NHPC for manufacturing polysilicon for solar modules. What would this deal mean for you?
BL is in business of making solar cells and solar modules and putting up the megawatt solar power plant already. Though our capacity and the technology in making the solar cells and the solar modules was limited, now going with this MOU with the NHPC, which we signed very recently, we are creating the infrastructure. In fact, right now it's the understanding and the intention to put up a gigawatt size power plant capacity, not only making the modules or cells, but the wafers and ingots as well. As you already know, we are, as a country as a whole, we are proceeding towards the green energy, whether it's a solar, wind, or hydrogen. So enormous potential is there, but at the moment with NHPC, we have signed this MOU. We may go for a JV, setting up together with a 5,000–6,000 crores of capex. But what all it will bring in, it is too immature to say at this moment.
Okay, what is the update on the semiconductor fabrication plant? Have you received the ministry approval for this?
No, it is still under the scrutiny. Discussions are taking place at different levels. We have given, along with HAL, our proposal. Whenever this comes through, of course, we intend to spend around 2,500 crores on BL side. But definitely, at the moment, it's in the approval stage. It will take a year or two to come up at the level of, starting putting up the plant. And it will take 3-4 years that the business start, coming in.
Mr. Batra, we saw strong numbers in Q1 and now we're already 2 months into the second quarter. Could you tell us how has the performance been so far in Q2? What are revenue and margin expectations broadly?
These are in line what we had planned, and when the second quarter gets closed on 30th of September, we will share those figures with you. At the moment, I can only say that on the complete year basis, we are on the way to achieve at least 15% growth. And of course, the profit margins, EBITDA margin, what we have discussed, I've given the guidance already. It will be around 22 to 23%. However, I'm more confident it being on 23% around.
Okay, well, on that optimistic note, thanks a lot, sir, for joining in and giving us an update on the business. That's BEL, been one of the strongest stocks lately, sitting on a fresh 52-week high. What's also showing some strength this morning is the companies that have an exposure to North America, because the August truck orders have risen to a 5-month high of 21,400 units. We have the management of GNA Axles, a company that supplies to the CV sector in North America and gets 50% of its sales from CV exports. Ranveer Singh, who's the Managing Director and Chief Executive Officer, joins us now. Mr. Singh, good morning and thanks for joining us. I do know that, CV exports constitute about 50% of your sales, but particularly to North America, what is the exposure right now? And are things improving? Because July was a very weak month and suddenly in August, the orders have gone up. What is the situation on the ground?
Sonia, very good morning. Thanks for inviting me today morning. The CV market in North America is continuing very strong. And though there are issues for their assemblies, their manufacturing, there are different reasons. That is like the chip shortage, and they have still a manpower shortage also. Post-COVID, 100% people have not come to the job. So that is also one of the reasons. Another part, the positive thing from India is that all Indian suppliers, component suppliers, that is what I heard, they are performing very well. Even during the COVID and post-COVID, supplies from India were totally 100%, and there was no production loss because of the Indian component suppliers from India. As so far as our business is there, our orders are intact, and whatever we have performed in Q1 and Q2, we are doing. Those orders are same, though they have their internal fluctuations in the assembly. If you see the year 2023 also, the outlook is very good and a very strong Class 8 market in North America.
Right. Sir, what's the exposure to Europe for you and how is that market doing?
Europe is still continuing very strong and a very stable market, and we are performing good in Europe also.
Okay. What would this mean for your overall business? Earlier, you had told us that you hope to grow the top line by 15% in FY23. Now that things have picked up, would you like to raise your guidance?
Sonia, as first 2 quarters in last year also, we have performed very well. But suddenly in Q3 and Q4, there was a correction in the inventory correction in USA, then tractor market correction was there. But it is too early to say anything. If it will continue like this, definitely will grow between 15 to 20%.
Okay. And in that 15 to 20% growth, your CV exports are 50% of your sales. So the rest of it is coming from the domestic market. Can you tell us what is the growth that you're expecting here?
Sonia, overall, our export is around 55 to 60% revenue comes from export. Part of that is off-highway also in export. And North America constitutes around 30%, 35% of our total sales revenue comes from North America, whether it is CV and off-highway. And this overall sales will grow 20%, 15 to 20%.
Okay.
13 to 14% margins, sir? Or will that
margins have, as you know, this year also our margins have dropped because of very steep hike in the steel and material content, and it has come down to 13.7. But we are very hopeful we'll be able to maintain between 13.5 to 14.5% in this year.
Okay. I wanted to talk a little bit about the tractor segment because 40% of your domestic sales comes from the tractor market. And there, after many months of a degrowth, we are finally seeing a growth from players like Escorts and M&M. What is your order book there, and is it growing? And how much would it contribute to your overall business?
Sonia, a little correction. Our domestic revenue, 70% comes from off-highway. That is basically from the tractors, 70 to 75%. Okay. Tractor market is very stable. But in GNA axles, year-on-year basis, we are increasing our market share. It has grown from 65 to now over 70% market share in our axle shafts in domestic market. Tractor market is very stable, and we are hopeful this will continue this year. But there will be some correction in Q3, maybe for a couple of months. We are hopeful in coming season the sales will be good in tractors also.
So you said you have 70% market share in the domestic tractor market, is it?
Yes, over around 70%.
And how much has it gone up by compared to, say, a year ago?
Please say again.
How much has the market share risen, say, in the last 1 year?
It's a stable, you know, okay, it's a very stable. And one more input I would like to give about the tractors, like low tractors up to 70 horsepower in India, the production cost is lowest, I would say, in the world. So that market, global market and manufacturing base is going to shift to India, you know, like Yanmar, Kubota, John Deere, Same, others. You know, not many assemblers will increase their stake in India. They will increase their capacities, and that segment will come to India, and further tractor market will grow, you know, especially in export, the growth potential is great.
All right. And of course, you're doing more stuff, right, with SUVs on the EV side, but that we'll leave that for later. Thank you very much for giving us some idea about how things are progressing so far. Thank you indeed. Well, the market is doing just fine. We are up 115 points, 17,653. So absolutely good going this Monday morning. It's a wrap on this edition of Bazaar from Sonia, Anuj, everyone on the team. Thank you very much for staying with us. A lot of trading ideas coming up on Chartbusters, which comes right up.